MK Investment Managers. Sachin, to start off with, given that we are now at the fag end of the earnings, how has Q4 panned out, and which sector stood out for you, and which sectors were a key drag here?
Yeah, so I think overall, I would say that Q4 earnings have been actually much better than feared. Clearly, most of the results are very, very good across sectors, whether it's automobiles, whether it's your banking space, whether it's private sector, public sector, even within the pharma space, whatever results that we've seen, all of them have actually been fairly good. Of course, IT services as a sector overall remains to be a bit muted. I think other than that, all the results, I mean, most of the company results have been fairly decent. I mean, they have been either in line or better than expectations. So there has been no major disappointment per se. But I think even more important, when we hear the management commentaries and the outlook for the next few quarters, I think what is very encouraging is that as far as the demand is concerned, the demand side is concerned, I think most of the managements believe that at the ground level, the demand seems to be very strong. The demand has come back after probably good 6, 7, 8 quarters. So I think that's a very positive sign. Of course, the only challenge that remains is in terms of your the raw material sourcing or the raw material inflation. So the entire supply chain challenges. I think those are the key things that everybody is a little bit worried about because to some extent the writing is on the wall, and how much will that actually impact the end demand is the key question, because there is going to be inflation, there is going to be cost push inflation, there is going to be some supply chain challenges.
Right.
So the real worry is in terms of can the demand still hold on?
Okay. As you were mentioning about the cost side, I just wanted to check with you, what is the FY27 earnings growth that you're penciling in, given the fact that crude and commodity prices continue to remain on the elevated levels?
Yeah, so the whole thing is a function of how quickly this Strait of Hormuz gets opened up and how quickly does the energy prices actually cool off. So suppose, just for argument's sake, if everything gets sorted in next 1 week, then yes, we will not have too much of challenges is what we believe, maybe 1 quarter or so. But beyond that, I think the next 3 quarters, we believe that things should be much better. Because, again, what we are hearing and what we are seeing also at the ground level, that the manufacturers have also behaved very maturely, because they have not taken some very obscene kind of price hikes in terms of their product level, because they are also trying to manage that how can they allow the demand to not get distracted, or how can they allow this demand momentum to sustain. So I think that's the real key thing. So at this point in time, I think we are keeping our fingers crossed, and if things don't go too bad, or if things actually get better off quickly sometime in this month, or early next month, then I don't think we are going to see a major impact beyond the first quarter, at least the next. All right, let's even if I have to be a little bit more conservative, I think the second half of FY27 should be a much better time, is what we believe at this point in time.
Right. Now, speaking about sectors now, you were talking about IT. Yes, the earnings were not that great, but we have already seen a significant fall in the share prices and the index. So do you think that the valuations are now attractive, or there could be further fall from the current levels as well?
Well, that's a very great question, I would say, at this juncture, particularly for the IT services, because the whole narrative against the IT continues in terms of the AI tsunami that we all are witnessing all around. But parallelly, what we are seeing is that today the stocks are available at probably 5% or 6% dividend yield. So the valuations, are they factoring in maybe 1 year or maybe 6 to 9 months kind of a very low growth? Because even today, if you see some of the managements out there are fairly confident that their order inflows are very strong, and a lot of their business which is not happening is not to do so much with AI tsunami, but it's more to do with a lot of discretionary spending at their customer end being a little slow because of other external challenges, whether it's geopolitical, trade tariffs, the worry about the US economy having a hard landing about say 12, 15 months back. So all of this was playing out, which is what has slowed down the discretionary spending. So as soon as probably that starts coming back, there is a good possibility that some bit of growth will actually come back in the IT companies, and then current valuations will look very, very reasonable or attractive. So yes, there is a case at this point in time where, and if you see even the last 1 week, IT services stocks have actually outperformed. If you see, the sector has actually
Right.
given good 5% return.
Right. And lastly, just wanted to check with you on the banking side. Private banks have been underperforming for a very long time. Do you see this as a structural derating or a cyclical opportunity now?
We strongly believe that the private sector banking, particularly the leaders within that, today are at one of the best risk reward valuations, the risk adjusted returns, or even from a risk reward ratio. I think they are at one of the best opportunities to invest for investors thinking with a 2-3 year horizon. Because if you see the valuations today for most of this large private sector banking, they are in the range of probably 16 to 20 times. And at the same time, we believe that they will grow at least 15% compounded for the next 2, 3, 4 years, because we've already seen credit growth also picking up quite significantly. The market share win by some of these banks is very decent, particularly on the deposit sides, and which is what to our mind is more critical, because that will lead to higher credit growth and better asset qualities. So to our mind, this is one of the best risk reward today in the markets.
Well, thank you, Sachin. Thank you for joining us and giving us your perspective on the markets and the sectors that we discussed. Well, banking is the best bet at this moment on risk-reward ratio is what Sachin's key takeaway is coming in. Now, shifting focus from markets to stock-specific action. Firstly, on